Here's everything that you need to know about the First Home Savings Account in 5 minutes or less. Because while I really like the idea of this program, you need to understand how it works if you want to avoid any unwanted negative tax consequences. The FHSA, the First Home Savings Account, is like the TFSA and the RRSP got together and had a beautiful baby. Now, not everybody can qualify for the First Home Savings Account. In order to qualify, you need to be eligible based on the two main eligibility criteria. The first is that you're a Canadian resident older than the ages of 18 and younger than the age of 71. And the second is that you could not have owned a home or lived with a common law or spouse that has owned a home in the last 4 years. If you qualify, you will be able to set up an account with your bank or your credit union, allowing you to deposit as much as $8,000 every single year. But don't worry, if you didn't max out your contribution limit in any given year, you can carry up to $8,000 of unused contributions to any future year. On top of that, just like an RRSP, all of those contributions that you make to this program can be done using income that hasn't been taxed yet. But just like a TFSA, account holders can invest in mutual funds, publicly traded securities, government and corporate bonds, and guaranteed investment certificates within the account. So that way, when it's time to buy a home, you should have a nice little nest egg set aside for your down payment. Now, that being said, withdrawals from this account are only tax-free in the event that you meet certain criteria. The first is that you still need to be a first-time home buyer and resident of Canada at the time of the withdrawal and during the purchase of the qualifying home. You also have to have a written agreement to buy or build a qualifying home located in Canada before October 1st of the year following the year of withdrawal, and you also need to intend to live in the property as your primary residence, demonstrating that you yourself have moved into the property within 1 year of purchasing the place. So that means no, you cannot use the First Home Savings Account to purchase a rental property, although as of right now, legal suites and duplexes still count. Once you open up your First Home Savings Account, the clock starts ticking, and there's one of 3 ways, other than buying a house, that your account could be closed. The first is that you turn 71 years old, in which case you no longer meet the eligibility requirements and your account will subsequently be closed. The second, though, is that you'll have 15 years upon opening your account to purchase a home. Now, this is a long time, so hopefully that won't be an issue for you. And lastly, you yourself could close the account. Maybe a life event came up and you need the money for something else, or maybe you don't intend to buy a property in Canada anymore. In any event, no matter what reason the account gets closed for, you'll have 2 options. Either you can take that money back and pay taxes on it as if it were income, or you can transfer it into any RRSP that you own. Now, before you leave this video, there is a couple other things that you should know. The first is that the government did intend to launch the First Home Savings Account on April 1st of 2023. But as of right now, you still have no ability to get one because all of the major banks and all of the major credit unions are still waiting on the final approval from CRA. And this is expected to take at least a few more months, although they are promising that it is coming out in 2023. So if you're watching this before your financial institution has it available, you'll have to wait. The second thing is that if you're not subscribed to my channel, you should be, because people are 62% more happy in life if they're subscribed to my channel. I'm just kidding. They're 69% happier.